Hello and welcome to BQ Prime. You're joining us on this special episode of Bankable, where we're joined with Mr. KV Kamath. And of course, Mr. Kamath, nobody needs any introduction to talk about Mr. Kamath. Over 50 years in the Indian banking system, overseen one of the largest financial services entity in the country, then went to New Development Bank, came back to India. So, Mr. Kamath, I just wanted to get your sense. 2023, where we are and the kind of growth that we're finally seeing in the banking system, right? And this is coming after a decade of significant slowdown. I want to get a sense from you as to what is the quality of this growth that you're seeing at this point in time. How do you see it in terms of benefiting bankers, benefiting the economy, benefiting promoters?
I think the growth that we are seeing today is a welcome growth, and that growth is on a fairly large base. It's not on a small base. We're talking about 3.5 trillion. And I would think it should run at the rate that the government is been saying it would, and the Reserve Bank is numbers that they're saying. I would entirely endorse it. The reason I'm saying this is that sometimes you say growth is hollow or growth will fizzle out. In India's case, neither is true. Simple question I ask myself is, do you have the need to grow? Now, and put in contrast, there will be Western countries which there is no need to invest in infrastructure, for example. So where do you grow? Whereas in India, just infrastructure itself will keep us engaged for 25 years. All the things that we need to put in, and I won't elaborate on that. And if you see other transformations that are taken in other large economies, infrastructure was the key driver of growth for these economies. Right. So we will have it. And along with that, we have then aspirational growth. And that is all the things that are manufactured, which you and I consume. I think the aspirational growth. The third layer in India, which is very interesting, it is a young growth. The young of the country are driving growth. In most other economies where growth happened, it was a slightly older generation which was driving growth. Here, there is growth at the young level. If you want to pick another layer, I would put another layer. That is what we traditionally call the bottom of the pyramid. They are also driving growth, because their aspirations are reset. And of course, there is affordability in a lot of things that they aspire for. To take just one example, the device in your pocket, which the previous generation could not afford. They did not have such a device. Even if they had it, they could not afford. But the young generation can at an aspirational level at a very young age. So all these put together are throwing up growth at a pace which we have not seen before.
So when we are coming to this growth cycle in 22-23, do you think it reminds you a bit about what was happening back in the early 2000s when things started taking off on the infra front and the country was at a significantly fast pace?
There is a significant difference, and I have lived through that period.
Yes.
And see, what happened is the opening up of the economy in the 90s, and then coming to 2000 when Indian industry had to reinvent itself, took place. And then the full impact of certain policy measures taken by the government around the 2010 period. First was the opening up around 1990, but around 2000, not 2010 period, the 2000 period gave the momentum for infrastructure.
Right.
And it was not just that. Just prior to that was also the push given by the white collar industry by the IT revolution that happened. Correct. So these two things provided momentum, and then manufacturing caught on. For a variety of reasons, it tailed off. We won't go into that. And it tailed off for a fairly long time thereafter. But the last 10 years, we are seeing growth again come up at a very rapid pace. And those are on strong structural measures. One is, as I said, there's enough to grow. And there is a means of funding it that is being... And there is a widespread... It's an opportunity to grow, not just infrastructure alone, not just manufacturing alone, but this new aspirations which drive new things. And primarily the digital India comes from that aspiration. I think all put together is driving momentum. I think there's also another aspect which we need to put in context. I see for the first time all states, or a majority of the states, coming and saying, we have our own development plan. You go back to 2000, that wasn't there. Okay. And then slowly you saw it in one or maybe two states, but one primarily saying there's a destination particular state. But now every state by itself is a destination.
Right.
So you have, I think this will add further to the growth momentum.
Okay. I want to understand from you. So while yes, there's a lot of interest, at least on the retail and consumer side, amongst bankers to really grow fast. Add that double-digit, high 20s sort of a figure in terms of growth rates. But when it comes to on the infra side, it seems there's a little bit of hesitancy. Maybe it's not the right time, or private sector investment is not really taking off at this stage.
Yeah.
What do you say?
You're right. I would break infrastructure into two parts. I think those sectors which, 2009 onwards, the investment that took place came under pressure for a variety of risks, for a variety of reasons. Primarily what I call implementation period risk. So what you thought could be implemented in a particular way didn't happen for a variety of reasons. You had challenges with mineral rights, land acquisition rights, spectrum, coal, et al. There are a lot of reasons which have been now thought through and solutions found. But primarily the belief is that these sectors are best implemented by the government. The government is doing that in a rapid rate. Look at the road rollout and look at railway rollout and so on. The government is implementing that. But then there are certain sectors which now is very clear that infrastructure sector, which private sector can do. Telecommunications can be done well. Ports, whether airports, seaports can be done well. Yeah. So there is, I would think now, a growth which is holistic, government and private sector led in a variety of areas. The manufacturing sector is almost entirely private sector one. And the banks are again holistic. There is public sector and private sector. So I would say that this is the way it will continue for some time. And at the same time, the government investment is now getting released. So if you look at the InvIT structure and what the Highways Authority is doing in terms of the rolling over, it's through a process of releasing money through an InvIT structure and using that for doing fresh investment. I think augurs very well and is a good example for several industries in the public sector. So I think we will have a holistic growth going forward.
There's a running joke that every 20 years or so, the bond market gets together and says that we have to develop a long-term, in-depth sort of bond market. And this discussion keeps going on, but it seems that the results are never as satisfactory. What do we currently need that, or are institutions enough? Let me
put that in context.
Yeah.
You're right in the sense there has been talk of developing a long-term bond market, but I think for it to happen, the conditions have to be right. You have to have borrowers with a proven track record, who the regulator feels good enough to get to the market.
Yeah.
Public then who is going to invest has to have confidence, either through the public route or through institutions, whether it is the insurance companies or whoever, pension funds who invest in this. So that confidence was lacking earlier. And the answer is very simple. Till 2 years back or 3 years back, the debt equity of India, if you look at, overall was probably 1.8, 2:1, till 2-3 years back. 10 years back, it used to be probably 3:1. 20 years back, it was 4:1, total debt, long-term, short-term debt. So that has been corrected. And the top 500 corporates today are virtually debt-free. So they are now in a position to actually go to the market and say, look, I am of a quality the market can trust and give me the money. And I'm sure the regulator sees it in that light and will, one. Second is variety of market instruments. Now, InvITs are coming, which is again, so I think catching pace at a very rapid rate. So I think there are two reasons. One is quality, and the second is diversity of instruments wasn't there in that aspiration to have longer term instruments. But today I think it is falling in place.
I'm sure in your interactions with various pieces of this entire infrastructure story, I want to understand how promoters are looking at the system and the opportunity available right now. Is there, because that private sector, as you said, and some of the other bankers in the system have also pointed out, the private sector investment has not reached a stage where it really starts moving credit growth in a meaningful way. To your mind, how was the promoter looking at this?
You see, let's look at the continuum. Just looking at infrastructure may not be giving a full picture.
Sure.
An entrepreneur who's got a going business in manufacturing and these areas, small or large, I think today primarily looks at it from the point of view, how much cash am I throwing out, free cash, and what is the investment potential using that cash, not looking at too much debt. Maybe some working capital debt on the margin, but primarily using this money. Opposed to, as I told little while earlier, 20 years back, where it was, how much can I leverage?
Correct.
I got X. Can I leverage 3 times? Then my project size is 3 times. Today, do I have X? Then my project size is X. But that X has become larger and it is meeting the needs of it.
Yeah.
That's in the manufacturing side. On the infrastructure side, that cannot happen until you have rolling stock, which is
right.
As again I mentioned briefly, the Highways Authority today has rolling stock which can brought to market, and they build something new using that money. So they don't have to come back to market to raise money for investment. So I would think that, and as far as banks are concerned, given the challenges that the private sector had with the infrastructure sector over the last 15 years or so, banks would be rightly wary that let us wait and watch. The investors are also wary because that's a business which at the moment cannot be done with cash accruals or free cash flow.
So what pushes things? What changes the status quo?
I think I'm very clear that for quite some time, the infrastructure sector, key parts of it will be government-led.
Okay.
But there will be parts, telecommunication, ports, airports, which will be private-led as well. There will be several more. I'm talking the headline parts. Then slowly what will happen is government will say, I will monetize. Then you may have a private sector company come in when the initial risk is taken care of. And I would like the government to get the return for that risk. They should get that return for that risk and then release the assets at market value so that they earn what the risk that they took, they get the good return, and then the private sector takes on. So this investment becomes a virtuous cycle.
For a promoter, do you think that there is also the equation between a lender and a borrower has changed completely after the introduction of the IBC in India? Now, suddenly there's this risk of losing your company because you default and the bank goes to court. Most likely, the court is going to rule in favor of the bank. Does that play into some amount of psychosis?
Absolutely. I mean, there is no doubt that has been a very salutary impact. And the behavior change in terms of not leveraging 1:4 is consequent to this behavioral change, which I think is good. Now, the other thing is, going back 50 years when I started my career, the debt equity of a project was given, 1 equity, 2 debt. That's the way you will do it. It was like cast in stone. For 40 years or 30 years, it continued, in that measure.
Right.
But today has changed because the free cash flow from the system is larger. The checks and balances are different. So today's, entrepreneur has to think differently, which he is. And today's banks have to think differently. They are. So I think it is not slowing down growth. I am not seeing any slowdown in growth. I think it is good growth because it's coming through your cash generation. And that is sufficient to meet growth aspirations of an economy growing at 6-7%. I think there is enough cash flow to free cash flow to support that growth.
I want to get your view a little bit on the current regulatory environment that exists alongside the business, of course, that's going on. On the monetary policy side, the Reserve Bank of India, or the MPC for that matter, is running slightly behind where inflation is at this point in the country. You're also seeing some, difficult but necessary sort of steps taken by the Reserve Bank as far as supervision is concerned, as far as regulatory implementation is concerned. Do you think that there is some level of this regulatory risk that is rising?
No, let me put it in context. As far as banking regulation is concerned, the tightening that you said, I think is world class. In fact, I would say it is beyond world class. I think it is at a level which we can all look up to and the rest of the world can look up to. The checks, balances and things like that, so that you do not allow any systemic error to creep up and become a big problem. So that is in place. On the monetary front, I think this last 2-3 years has shown the Reserve Bank in a light which I think we should admire.
Okay.
Because this sort of difficulty, I don't think an institution has ever faced. Maybe there was the 2030s where, you and I weren't around. But even the 2009 crisis was not a patch on what we saw in the last 2-3 years. And to rise to that occasion and do what was necessary and was not prescribed. By that I mean, prescription was that if inflation rises, keep interest rates higher. I think the policymakers rightly thought as to what is the cause of inflation And then let us see whether that can be addressed rather than just raising interest rates and making a difficult situation even more difficult. One. Second is provide liquidity support as necessary. Bold step, and kept that liquidity window open. And even now it's open by and large. And I think so. Every step that was taken and in sync with the central government to support the base of growth, as it were, I think worked out well. And I think in a way, I would say as an aside, probably we are now looking at a rewrite of economic theory, which the old economic theory said if inflation rises, just increase interest rates. To now a more questioning theory that if inflation rises, first question what is causing inflation and then give the medicine in the right dose. I think that is very welcome. And I'm sure actually our regulator, our economists can look at this and write a new chapter in terms of what could be done. So I'm very happy with what has been done, and I would think we are on the right path.
Do you think that this rewrite of theory is sort of an outcome of having a more group-led thought in monetary policy setting rather than just the RBI taking its call and so on?
I think that it is a combination of both, because I hear voices of the theoreticians, and they are conservative, and I respect that conservatism. But I hear a whole lot of voices which are also, I think, understanding the situation and taking a call. And it's a balanced view that is taken. You mentioned about inflation. The other thing that we need to correct is getting our numbers right. So what numbers the policymakers have to rely on are not very clear. For example, now I'm seeing a lot of literature just now which is saying that these numbers cannot be right. The inflation numbers cannot be right. As a lay user, I can say, if you look at, you talk to a housewife, what has happened to your budget of buying fruits, vegetables and things like that over the last 6 months, you will see the trend. So you cannot see how we can say the trend is different. So no, you have facts in front of you. So somewhere our data capture is probably not right. The base year is not right. Something is I think askew and needs to be set right for us to be able to then better calibrate.
Base year is 10 years ago. So.
Given all that, exactly. Base year is 10 years ago. 15 years back, this noise, we had started raising about industrial growth. Those numbers were set on 10-year back index. And what I found was there are, manufacturing industries that we don't exist. Textile production from mills. By then, textile production had moved to, the what we would call the non-organized sector. But you still had a weightage for that. Production was zero. So you would show a skewed number. Anyway, that has gotten corrected. I would think a similar thing here is required to get things right. And the measurement itself, I think, is probably needs to be set right.
Okay, fair enough. Last couple of questions. I want to get your view on the nature of the consumer growth. So historically, for a very long time, at least since I've been covering the sector, it's always been said that household debt has been, or financial debt towards households has been lower in India. The penetration of formal financing is low in India, and therefore there is such a big opportunity for banks and fintechs or NBFCs to get into that space. It has risen. It still continues to be middling. I just wanted to get your view on what that situation is like.
See, my view is that of a conservative banker. I think there was historically debt aversion. And to that debt aversion then there was probably as retail lending burgeoned in the 2000s. There was exuberance in people. But after the advent of the scoring companies, Sibyl et al., I think behavior change started happening. So you today know that if you go on a binge and borrow, and tomorrow you don't pay, your credit is going to be impacted, and you are in a dire position thereafter. I think every borrower is today conscious of that. So we have a informed borrower today, informed to the extent that he or she knows that there are consequences to behavior which is not. So I would think today the consumer is absorbing to the extent that he or she can absorb a debt. It is a healthy situation. Now, where will incremental opportunity come from? Incremental opportunity will come from probably reaching to those customers we are not today reaching, but who will be having credit probably could borrow credit up to a particular limit which needs to be determined. So I think that's where the opportunity comes for banks. And this opportunity, I think, by and large, will come digitally. So we need to see how do we score customers, how do we make sure that their aspirations and their ability to service debt meets and lend at that. And that will be the growth pattern.
Do you believe digital can solve that, the distribution or the reach problem?
Digital can solve it, but your evaluation metric has to be robust. And that evaluation metric starts from your current credit score. What are the data fields can go into that, and then provide a wholesome, an output which is reliable and can work going forward.
I want to close this with your view on what is the biggest risk to the system at this point in time, and something that if you take care of that, you're pretty much set.
See, risk always the risk that I've seen in any domain is a risk of a sudden slowdown. Because the consequences of that we have not really seen in any significant measure.
But you can't control that, right? As an entity.
But not as an entity. I'm looking at it as systemic risk.
Sure.
You control it at the systemic level, then historically there's another part of it to say that I don't want inflation to rise. That's a risk that I want. I'm taking it. We have very conservative managers on that risk, so we will not run that risk. So okay. I take it as a given. If I take it as a given, then we need to make sure that growth is not curtailed. I think we are in what I call in a fairly comfortable climate-wise comfortable. Climate, as I see, or the environment is comfortable. We have a long runway to growth, which very few countries have. We have the momentum in terms of, as I said, clean companies, clean balance sheets of banks, which can provide the cash flow support to grow. Thereafter comes global shocks. Will global shocks impact us? Last 2 years have shown that we can grow on our own, insulating ourselves from these shocks to the extent that we can, including the anticipated oil shock.
Right.
In the meantime, we are substituting oil with green energy and so on. So I would think that, to me, if you ask me, the biggest risk that we have is to quickly make sure that we are inured completely from any oil shock. And that is go green and develop our own sources of non-fossil energy. I think if we can do that over the next 5 to 7 years, we leave a legacy for the future.
So ESG focus, essentially.
Absolutely ESG focus.
All right. Thank you so much, Mr. Kamath, for joining us.
Thank you.
Thank you.